if we peak out at 6,000 to 7,000 on the S&P, as I'm forecasting this year, we could drop to as much as 80% down from there in less than a year's time. So it'll be a fast bear market. The economy will have probably double-digit unemployment. So it'll be rough. And again, this all sounds scary, except remember 2020, we saw something we had not seen in ever, I don't think, was shut down the economy. Unemployment rapidly went up. The good news in that, doesn't sound like good news, but the good news in that is that it will bring about deflation. So the inflation we're worried about now is mostly behind us. And I think by next year, we're going to be going into negative inflation or deflation. That means the central banks will have the freedom and the ability to print all the money they need to print. And you will see money printed at levels we've never seen before, because they will be dealing with a financial crisis, the likes of which you have not seen in your lifetime, I have not seen in my lifetime. And as a result, they won't have a choice. They will have to just pump money into the system at rates we've not seen. We saw incredible rates of money printing back in 2020. We had $5 trillion in the bank. The Fed's balance sheet expanded by $5 trillion. I'm guessing this time it will take $20 trillion. So something, the Fed's balance sheet, which is currently just below $9 trillion, I think will grow to over 30. We'll have a huge commodity cycle because that reshoring and all the industrial activity will boost demand for commodities to levels we haven't seen in a long time. And we don't have the supplies of commodities or the access to instant supply because of years of kind of shrinking commodity activity. And so you're going to have this perfect storm of rapid demand for commodities, nowhere near the supply to meet it, and prices go through the roof. So you will have a very fast inflation cycle starting probably, mid-decade. And by the end of the decade, I think we could see 20 to 25% inflation rates in this country and somewhat similar around the world. So it'll be a global inflation cycle, global commodity cycle, global industrial cycle. My view right now, I'm bullish gold right now. It's been frustrating to people, I think, although gold better than silver. Both gold and silver, I think, are poised for big upside here. I'm calling for pretty much coincident with the melt up, and it might carry a little beyond the melt up, but I'm calling for gold to go to 3,000 this year and silver to go to 60 this year. And silver's down around 22 and change, and gold's obviously 1,900 and change. So those are big moves. I think they will then go down during the bust with everything else. The assets are going to get hit hard. So that, let's say gold goes to 3,000. It could come back to where it is now in the bust. Better than the stock market, which I'm calling for 80% down, but still down sharply. From there, once the printing press gets going in the manner I'm talking, from say late 2024 or sometime in 2025, from the bottom, let's say it's back at 2,000, I'm calling for gold to have a huge run the second half of this decade and maybe peak out around 20,000. Amazon in 2000 was whatever it was, or in 2002 or 3, and that it was going to be where it is now, or Apple. If somebody talked to tech stocks 10 years ago, 15 years ago, 20 years ago at the prices and said they're going to go up 50-fold or 30-fold, you'd say, no way, how does that happen? So it seems crazy, but it's a huge cycle, and it's driven by the fact that we're going to see money printed like never before, and you can have an inflation cycle like we haven't had, bigger than the early 80s, and it's going to be prolonged for several years. Not to mention the dollar is going to be driven lower, et cetera. So there's going to be a lot of reasons for it. And I actually think silver will probably get up to 400 or 500. So, it's in the low 20s now. That's a huge run. Copper will go through the roof. I don't have a target, but it will go through the roof. I'm calling for oil to be at $400 or $500 a barrel by the end of the decade. So this is when I say this will be a commodity cycle like none we've ever seen. It will be. So, index funds, which have been the place to be, you didn't have to pick stocks. You just put your money in an S&P index and you outperform most managers in the last 20 years. Going forward, after the peak, that's not going to be the case. Index funds are going to suffer. So it's again a matter of knowing your cycle. There's new leadership in every cycle. Well, the next cycle, the leadership is going to be in the commodity area, in the industrial area, not in the consumer area, not in index funds. And so I would point you to the 2001 to 2011 bull market in gold. Gold went from $250 in 2001 to $1,900 in 2011. That was not a bad time for owning stocks. I mean, you had some periods in there where you had some bad times, but so you can have both move together. And coming out of the bust, if the stock market's down 80%, from that 80% drop, you're going to have a cyclical bull market, not a secular bull market, but a cyclical bull market in stocks. So let's say the stock market tops out at 6,000, goes down 80%. That's 1,200 on the S&P. The S&P can quadruple, can quintuple. Well, let's say quadruple. And that would get it back to 4,800. It'd still be way short of the 6,000 top, right? So you can have a secular bear, a cyclical bull within a secular bear. So coming out of the bust, there will be opportunities across the board in stocks. But as we move through that cycle, meaning within the year or two, the stock market's going to top out and start being hit by high inflation, high interest rates, whereas gold's going to keep running because it benefits from inflation. You will see money come out of every central bank at rates we've never seen before. And so with a lag, and it is a lag of probably 6 to 9 months, that will begin to show an upturn. So let's say it happens in 2024. By mid-2025, we should be coming out of this. So deflation, yes, but that deflation will last be a short-term deflationary cycle. I think Jim Rickards, I don't know his call exactly, but I think he's probably talking about a longer deflationary period. And the reason he said central banks don't like deflation, or whatever the quote was you gave me, is it's very hard